Welcome back. It's JWalter here. In today's housing market update, I'm going to be sharing an update regarding 40-year mortgages. Yes, you heard me correctly, 40-year mortgages, because I noticed that the FHA, or the Federal Housing Administration, actually is proposing for a new 40-year loan modification. So with that said, let's dive into today's video. This is according to an article on housingwire.com, but I'm going to be showing you the actual bill or the actual proposal as well. So at a high level, here's what they're looking to do. The Federal Housing Administration, or the FHA, is moving to expand its loss mitigation plan by introducing a 40-year loan modification option and is asking the mortgage industry for input. The proposed rule, again, this is not finalized yet, this is just a proposal. The proposed rule published by the Department of Housing and Urban Development late last week would change repayment provisions for FHA borrowers, allowing lenders to recast a borrower's total unpaid loan for an additional 120 months. And HUD's saying that this could prevent several thousand borrowers a year from foreclosure. So basically this would recast people's mortgages from 360 months or 30 years to 480 months or 40 years. And they're saying the results of this would be a more sustainable monthly payment, and of course it would reduce the amount of foreclosures that could potentially happen with 30-year mortgages. So with that said, let's actually look at the actual proposal itself and all the details regarding this. Again, this is only a proposal. It's not finalized yet, so don't get too excited about this if you're looking to get a 40-year mortgage. The publication date on this was the 1st of April, and this is on the Federal Register website. This is federalregister.gov. I can leave a link below for you guys if you want to take a look at this. In any case, the publication again was on the 1st. It says HUD's current regulations allow mortgagees, which are lenders or loan servicers, to modify a Federal Housing Administration or FHA insured mortgage by recasting the total unpaid loan for a term limited to 360 months to cure a borrower's default. This proposed rule would amend HUD's current regulation to allow for mortgagees to recast the total unpaid loan for a new term limit of 480 months. Obviously, there's some pros and cons associated with this, and I'm going to be going over that here in just a little bit. They went on to say that this would further reduce the borrower's monthly payment as the outstanding balance would be spread over a longer time frame, again, 30 years to 40 years. This would provide more borrowers with FHA-insured mortgages the ability to retain their homes after default. It also said this would align the modifications available for those who have loans that are backed by Fannie Mae and Freddie Mac, who both currently offer 40-year loan modification options. And they're asking the public for comments regarding this, and comments are due on May 23rd, 2022. So I would imagine by this summer, we'd have some idea regarding this is going to become an actual rule or not. To give you guys a very brief background, the FHA was established way back in 1934. They established some regulations in the mortgage industry that address a mortgagee's obligations to offer loss mitigation options when a mortgagor defaults on a loan. So a mortgagee is a lender or the loan servicer, and the mortgagor is the person who has the mortgage, the homeowner. Mortgagees or loan servicers are required to consider utilizing deeds in lieu of foreclosure, pre-foreclosure sales, partial claims, assumptions, special forbearance, and recasting of mortgages as loss mitigation options. So way back in November 6, 1997, they added loss mitigation options, and one of these options was to allow mortgagees, or again lenders, to modify a mortgage for the purpose of changing the amortization provisions and recasting the total unpaid amount due for a term not exceeding 360 months from the date of modification, in other words, 30 years. However, here's the new proposal. HUD is proposing to replace the current maximum of 360 months with a new maximum of 480 months, or 40 years. This would allow mortgagees to provide a 40-year loan modification that would support HUD's mission of fostering homeownership by assisting more borrowers with retaining their homes after a default episode while mitigating losses to FHA's Mutual Mortgage Insurance Fund. They said an additional 120 months on the length of the recast mortgage would allow for a lower, more sustainable monthly payment. However, I'm going to be going over some cons associated with this here in just a little bit. Therefore, a lower monthly payment is a key element to bring the mortgage current prevent imminent redefault, and ultimately retain their home and continue to build wealth through home ownership. So by reducing the borrower's housing payment, they say this should be sufficient to prevent several thousand borrowers a year from foreclosure. And here's a note regarding loan forbearances. So borrowers impacted by the COVID-19 pandemic, including those who may redefault in the future after having received a loss mitigation option under COVID-19 policies, again a loan forbearance, may need a 40-year loan modification to obtain affordable monthly payments that would allow them to stay in their houses. This would also reduce losses to the MMI fund, as fewer properties would be sold at a loss in foreclosure or out of the FHA's or REO inventory. However, here's the downsides of moving from a 30-year fixed rate mortgage to a 40-year mortgage. However, here are two major cons with this new proposal. Number one, slower equity accumulation, and number two, additional interest payments over the course of the modified mortgage relative to a 30-year loan modification. So in other words, if you move from a 30-year to a 40-year, you're going to be paying additional interest payments, and of course, it's going to take you a longer time to accumulate equity in your property. However, they say slower equity accumulation and additional interest would be greatly outweighed by the benefits of being able to retain your houses. Also, a borrower is not obligated to carry the loan for 40 years. FHA data indicates that the average life of a 30-year FHA insured mortgage is approximately 7 years, and of course, not 40 years. So it says here the 40-year mortgage remains rare, but has become more commonly recognized in the mortgage industry. They say Fannie Mae and Freddie Mac, the National Credit Union Association, as well as the U.S. Department of Agriculture all have 40-year options. So you're probably wondering, what is the difference on your housing payment for a 30-year fixed rate mortgage versus a 40-year? So have a look at this. Here's some calculations I did. So assuming a loan balance of $340,000 at an interest rate of 5% for a 30-year fixed rate mortgage, your payment for principal and interest only would be $1,825.19. However, with that same example here, a loan balance of $340,000, a rate of 5% over 40 years, your payment would only be $1,157, or about $670 less per month, given you move from a 30-year loan to a 40-year loan. Another big difference when you look at these amortization tables for these two scenarios, though, is the amount of money that goes towards your principal, which pays down, of course, your loan balance. So when you look at the 30-year rate here, in 2023, based on this scenario here, you would pay down $5,207.52 towards your principal, again in 2023. When you look at the 40-year loan, look at this though, in 2023, you'd only pay down $2,004. So about half as much go toward your principal in 2023 when you're looking at the 30-year versus 40-year mortgages. Also, when looking at this graphic here showing how much of your payment goes towards principal for the 40-year loan, take a look at this because it takes all the way until 2032 for you to have at least $3,000 towards your principal. Also, when looking at this graphic here showing the total number of principal that's paid down each and every year for the 40-year loan, look at the small amount that goes towards your principal. I mean, it takes all the way until 2042 to reach $5,000 in principal paid off. When you look at the table here for the 30-year loan, back in the first year, 2023, you already have $5,207 paid off towards your principal. So it takes a long time for you to pay off your principal when you have a 40-year loan versus a 30-year. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day and look forward to seeing you on the next video.